Thanks for joining us today on The Close. I'm Morella Fernandez. Markets close in 30 minutes. Let's get to the stories we're following in the BNN Bloomberg newsroom. Ottawa is changing its auto framework to help local production and will also change its tariff system to create a stronger incentive for automakers to invest in Canada. There will be consultations on a new import credit scheme to help automakers lower their tariff bill, and counter tariffs on American-made cars and trucks will stay in place. The federal government also wants to drop the 2035 EV mandate and brings back the consumer EV incentive. Bank of Canada Governor Tiff Macklem repeated that the Canadian economy is undergoing a profound structural shift. In Toronto, he warned of years of modest growth to come and said rate cuts might not work in fueling increased economic activity. He added that monetary policy should not try to compensate for lost supply and said that Canadian executives need to adjust to the new economic reality. And shares of BCE seeing some pressure today. The telecom giant posted profit in its latest quarter that beat estimates, but saw operating revenue fall below expectations. BCE says it expects higher revenue and profit driven by improvement in wireless pricing, a boost in product sales, and growth in its AI-powered segment. A reminder, BCE is a parent company of this channel through its Bell Media division. Shares of Barrick Mining are sliding. The miner posted profit and revenue in its latest quarter that topped estimates, but investors are pointing to the company's weak production outlook for 2026, as well as free cash flow that came in below expectations. Also today, Barrick announced it's going to spin off its North American gold assets in an IPO, which will include interests in Nevada and the Dominican Republic. The TSX dropping close to 600 points today. We'll bring up that market shot in just a moment. Most of the North American markets are trending down today, again on a lot of concern about tech stocks. So 595 points down, that's 1.8%, and taking the TSX down under 32,000. South of the border, an 88-point drop, so 1.3% drop for the S&P. A 1.2% drop for the Dow, it's down 590 points. The Nasdaq down 1.7% today, so a grim day overall for the North American stock markets. So as we mentioned, the Prime Minister announced some major changes in policy for the auto industry today. It includes bringing back EV incentives for consumers, all part of a 5-point plan to transform the auto industry.
Canada continues to favor a zero tariff regime with the United States in autos because we know that will deliver the strongest North American auto industry. But if the U.S., through the CUSMA review, insists on some form of auto tariffs, we'll ensure that companies that sell vehicles in Canada are strongly incentivized to produce in Canada.
Let's go to Flavio Volpe. He's president of the Automotive Parts Manufacturers Association and one of many who've been calling for changes for a long time. Flavio, thanks for joining us today. First of all, what's your overall reaction to the announcement?
Well, look, it shows that the government of Canada, and led by the Prime Minister, listens to the industry. That said plainly, the old system, the EV mandate, picked one specific technology at a moment that wasn't available to Canadians and wasn't available to Canadian manufacturers. And we said we're all committed to electrification. We have to have a ecosystem approach where we make it easier for Canadians to buy them. We make them more available. We invest in the infrastructure to charge them. And we bonus Canadian companies who are making lower carbon emitting vehicles and parts to benefit from this. I liked it. There was a risk here that we would end up in another system that said, look, let's just pick one technology and force everybody there. This allows everybody, including the companies that we're chasing in hydrogen and companies who make internal combustion but make more efficient ones, to have a path.
Okay, so let's dig into it a little bit more. What do you see as a benefit, if you do, of swapping out a sales mandate for an emission standard?
Well, look, the sales mandate said the only way to get to the point that we want is if you build electric vehicles and you build 60% of them by 2030 and 100% by 2035. And the only way to get there is if Canadians bought those cars. So it didn't do anything, though, to get the Canadians to buy those cars. But what it did was penalize producers for the lack of demand. Why were we going forward with an electric vehicle mandate? Well, we wanted to take carbon out of the tailpipe across the fleet of vehicles that are sold and manufactured in this country. So the Prime Minister said today, look, we're targeting outcomes, and that's carbon reduction to 72 grams per kilometer. And you can get there any way you want, but you have to get there. For Canadians who want electric vehicles, we're going to make it easier for you. We're going to give you a $5,000 rebate. And for those who want them, but for whatever circumstances or use case, only want to go plug-in hybrid at the moment, there's a brand new one. It's $2,500. And by the way, if you want them, and money isn't really the issue, but charging is the issue, the government is making this monumental investment of $1.5 billion into the charging infrastructure across this country. There's enough there for everybody, the consumer and the manufacturers, and for those manufacturers that we want to come here. There are no Canadian manufacturers of vehicles, just of parts. But, we're trying to chase companies like Hyundai to make the business case, and their hydrogen-powered vehicles did not make the grade in the former EV mandate.
Okay. So there is still a goal of having 75% of vehicle sales be EVs by 2035. So don't you think that just kicks the can down the road?
No, actually, it isn't a goal of 75% EV sales. What it is it's a reduction in carbon that would be the equivalent of 75% EV sales. What this is going to do is going to take those companies that right now, for their vehicles and those use cases, have V8s or 6-cylinder engines, and say, you can get there to that carbon target with smaller, more efficient engines, or you can get there with plug-in hybrid, or you can get there with hydrogen fuel cell, or you do it in boiling warm water. However you want to get there, the carbon at the tailpipe is equivalent to 75% EVs, but we're not going to tell you they need to be EVs. They just have to reduce the carbon that we emit. And in the end, we don't have a climate crisis because we don't have EVs. We have a climate crisis writ large because there's too much carbon being emitted by industry, by consumers, by society. So this says you're going to have to do your part as automakers to reduce the carbon output. How you get there could be your choice, whatever recipe that you have. And you have to get there. If you don't, you can't certify those vehicles. So Canadians whose priority is making advances in climate and not necessarily making EVs should know that the government of Canada did not relent on the climate objectives here. It just said, hey, especially to the companies that are invested here, buying Canadian capital and equipment and employing Canadians, we're not going to bonus the Chinese who are way ahead on EVs here. If you can find your own way there, we'll co-invest with you, but you must get there.
Okay. You mentioned that we don't make EVs in Canada. We make parts, but we don't actually make the vehicles. What in the announcement today will bring some of that production or lure some of that production to Canada?
Well, to be clear, I'm saying there's no Canadian auto company that makes EVs, but there are companies in Canada making EVs and plug-in hybrids and conventional hybrids. That's anything from Stellantis down in Windsor to Toyota and Woodstock to Honda and Alliston. What this allows the companies to do is to say, look, you can offer an EV product and a plug-in hybrid or a hydrogen fuel cell, and some companies like Hyundai do all of them. Toyota does all of them. And it says, you don't have to just be in the business of making EVs and hoping that somebody buys them. You take your whole fleet of everything that you do, and we're going to reduce carbon by 57% by 2035. And however you get that mix there, know that product has to be sellable to Canadians. We'll help them buy them if they're EVs. But if you want to get there in another mix, you can. That allows those companies to take different risks on product designation. Why would they do it in Canada is the question you're getting at. In this country, we have the world's biggest supply of the critical minerals and the chemistries that go into the batteries of all of those vehicles. A battery in a Mustang Mach-E is about half the value of the vehicle. Right now, they're being manufactured in North America, but they don't have Canadian chemistry in them. Why? Because we haven't made the business case yet for our critical minerals. So the more flexibility that manufacturers have, the more flexibility they get in the windup. But together with the other things that this government has done on major projects, permitting and infrastructure support, we could start telling Ford Motor Company that you can get the lithium from Canada in 2030 at this quantity, at this price, at this location. This is just a much more mature approach and an ecosystem approach to the same problem, but one that's realistic for companies that are already invested in Canada, that are buying Canadian parts and employing Canadian workers. And that's really important given what we're facing at the White House.
All right, Flavio, got to leave it there. I'd love to talk some more, but I'm out of time. Thanks for your time. Appreciate it.
Thank you.
Coming up next, markets continue to go through a sell-off led by tech. Investors still questioning the future of the AI trade. Back in a moment. Markets cratered for the third day as a sell-off in major tech stocks intensified. Our next guest suggests value exposure could help mitigate some of the weakness we see. Let's go to Jordan Jack. He's global market strategist at JP Morgan Asset Management. Thanks for joining us today.
Thanks for having me.
Do you see the software sell-off as overblown?
Well, it's a real risk that we need to be mindful of, right? Software companies are really dealing with the fact that it's sort of twofold. You have those software companies that provide software as a service, so whether it be travel, payroll, taxes. If an agent can do those tasks for you, what are you really worth at the end of the day? So that's a real challenge that we're seeing across those cohort of software companies. The other cohort of software companies are perhaps those software companies that own the data or have some proprietary data or data sources that the agents can then leverage and use in order to provide that service ultimately. But the big challenge with those companies really falls back on do I need to have a subscription? Does the end consumer or customer need to have a subscription model? And that's going to directly impact their overall potential profitability. So, agentic AI is going to be very disruptive for the sector more broadly. And I think the markets are reflecting that. Do I think the sell-off is overblown? Perhaps some of the speed and the price action that we're seeing seems a little bit stretched. But I think, we're clearly seeing the markets decide for the winners from the losers.
I was going to say, what are you doing during the drag down? Are you getting out of some things, picking up in others?
I think, again, leaning more so into those software companies that have the data, have some proprietary knowledge that the agents will ultimately leverage or need to leverage. These software companies need to have sort of the pipeline of the businesses that they service. So those are the companies that perhaps can make it out of this on the other end. But those other companies that really an agent can do already what they're doing, they probably have some more difficulty and challenges ahead.
Okay. Are you looking strictly in North America these days? Or are you looking outside as well?
We're certainly looking global. We recognize coming into the year, the U.S. market was very, very expensive. We saw a very strong year in global stocks relative to U.S. performance last year. And we quite like that more value-orientated part of global markets because we know the U.S. is very tech-heavy, very growth-heavy. This is why when you see this software sell-off intensifying, it's dragging down the rest of the market more broadly. When you look at other value areas globally, markets like Europe, markets like Japan, I would also put Canada in that mix as well, although we are seeing a lot of issues in terms of the mining companies and their sensitivity to overall metal prices. So there's some challenges from that sector specifically. But in an environment where you have positively sloped yield curves that's supportive of financials, we continue to see this broader AI build out. So the impact that's having on broader infrastructure, the support that's having for industrials, that it also provides a lot of support for the broader value story. Then obviously just a lot of the political risk that we're seeing here in the United States hoping to diversify with some more of that global exposure we think makes a lot of sense.
Okay, let's get to the Bank of Canada governor says the economy here is going through structural changes. The rate policy can't offset. Are you expecting a hold in Canada, and what are you looking at in the U.S.?
We are anticipating a hold. The reality is, and we heard this coming out of the Bank of Canada meeting, that they believe that monetary policy is generally in a pretty accommodative state right now. Most estimates would suggest that they could be actually a half a percentage point higher relative to where the current policy rate is. So, we do think that the Bank of Canada is in a decent spot. Further rate cuts aren't necessarily going to be what will help to, drive stronger growth over the course of 2026. Now, how does that mean for, the Canadian dollar and the loonie? We do anticipate that in an environment, particularly if the Federal Reserve still has a little bit more room to cut rates while the Bank of Canada stays on hold, this does provide a bit of support and potentially some strengthening in the loonie over the course of this year, particularly relative to the USD.
Jordan, how much of a risk is the Kuzma review and what comes out of that?
Well, it's a big risk. The reality is the administration is very uncertain coming into a lot of these conversations. There appears to be, at least at first glance, some desire to get a deal done, and then, the opposite ends up happening. So it is a big risk. It could likely will increase overall trade uncertainty, policy uncertainty, and could ultimately continue to weigh on overall economic activity across Canada. So it is something that we're closely watching. We're hopeful for a deal that is beneficial for both the U.S. as well as Canada, but we'll just have to wait and see.
Jordan Jack is global market strategist, J.P. Morgan Asset Management. Thanks for your time. Coming up next, shares of Barrick Mining under pressure after the announcement of plans to divest its North American assets. Back in a moment. Shares of Barrick Mining down today over 8% after the company unveiled plans to spin off its North American gold assets into a new publicly listed company by the end of the year. Let's go to Lawson Winder on this. He's metals and mining analyst at Bank of America. Thanks for joining us today.
Well, thank you for having me.
First of all, what's your take on the IPO idea? Will it bring more values to shareholders, which is what they're promising?
Look, I think it's a bit of a controversial question. Theoretically, it should allow Barrick to crystallize the value in the North American business. I mean, one issue, though, with the IPO as proposed is that they're suggesting spinning out a minority interest. Potential issue with a minority interest is you have the overhang of the remaining shares. And so they do tend to trade at a bit of a discount when you have those minority IPOs.
Interesting. Okay, so there you want to retain the majority stake and they will have the control. Do you think that investors will still go for this?
Look, I think there's some that will. And the reason being is that the Barrick North American assets are among the best gold mining assets on the planet. So, I mean, quite simply, if you want exposure with the hope of future additional exposure, I mean, it's a way to get in on the ground floor, so to speak. But it could be a long wait before the company decides to spin out a majority and it ultimately is able to free float on a majority basis.
Okay. Revenue for its latest quarter, the fourth quarter, came in at $6 billion US, 65% increase year over year. Is this mainly from the price of gold?
Yeah, I think that's a very fair statement. Production was actually down somewhat year over year in 25 versus 2024. So yeah, there's no question that the price of gold was a major factor here. Costs were relatively well controlled, to be fair. But look, I mean, for that level of increase, you can only look to the gold price. But also don't forget that Barrick's a fairly substantial producer of copper. So a much higher copper price also helped those results quite a bit too.
Is gold production down for this company because of Mali or something else?
Mali was the big contributor. Some production issues at their Nevada Gold Mines operations was also part of the issue, and they sold some assets. So they sold their Tongon mine in in Africa during the year, and they also sold their Hemlo mine, which was their last major Canadian operation, to a local Canadian group.
Are the issues in Mali resolved at this point?
Great question. By all reports, and according to Barrick's report today, it seems like all systems go in Mali. They're ramping up that asset. They've directed the investment community to expect that asset to be operating at full capacity by year end 2026. So, I mean, I think if everything remains stable in the country, I think we can count on that asset coming back and again, meaningfully contributing to free cash flow. And I think it's worth noting, before the shutdown of that mine almost 1 year ago, it was contributing almost 20% of Barrick's total free cash flow.
Yeah. Okay, let's go to the forecast for production, because that's not meeting the estimate. Is that going to be Mali again, or what is hitting that goal?
It's right across the portfolio. I mean, if anything, I think a lot of the estimates coming in had very little allocated to Mali just because of the uncertainty of how that ramp up would go. And so it was kind of a little bit across all of the assets. The way we're thinking about the guidance today is, yes, it was disappointing, certainly much lower than what investors were expecting. But they've set their guidance at a level which allows them to, in our view, very comfortably achieve that guidance. You know what? If things go well, I mean, it could put them in a position to beat it. So I think they're just being realistic here with what they can achieve with these assets. And then keep in mind, there's new management at Nevada Gold Mines. So Tim Krebs is taken over of manager for the North American operations. And according to the reports today in the conference call, I mean, he did a very comprehensive review of the assets. And I think this is all part of that and probably bodes well for the future longer term.
Okay. In the last 30 seconds, tell me, would you consider buying Barrick shares right now?
Yeah, we like Barrick. A lot of that is because we like the gold price. So we think gold will recover once this correction plays out. We recently published a view that we think gold this year could potentially get to $6,000. Our official target is $5,000 for this year. So, look for places to add to Barrick. Another point we like Barrick is it is relatively undervalued versus its senior gold producer peers.
Got it. Lawson Winder, thanks for joining us. Appreciate your time.
Thank you.
Coming up next, the closing bells on Bay Street and Wall Street in what has been a pretty dismal day across the board. We're back in a moment. Here are the closing bells for the end of the trading day. At the Nasdaq, Clear Coratora ringing the closing bell. In New York, New York Junior League doing the honors. You're watching the close on BNN Bloomberg. I'm Morella Fernandez. Here's how we ended the day on Bay Street and Wall Street. A big down day for the North American markets. The TSX dropping 1.8%, 576 points down today. The S&P had a 1.2% drop, 84 points down. And the Nasdaq, a 1.6% drop. That's a 363-point downward movement. Let's get to the movers in Toronto, starting with the miners in the red. We have Vizsla Silver Gold, which is down 12.5% or 84 cents a share. We had spot silver down over 15% at one point today, so that's dragging some of these stocks down. Discovery Silver also into a double-digit move down percentage-wise, 12.3% down. That's $8.32 down, taking the price to $59.36. Let's get to Endeavour Silver. It is also down today. Endeavour Silver, dropping 11.9%, so close to 12. It is up 145% over 1 year, but it lost $1.94 per share today. Okay, Celestica on the green today, or in the green, 24.38, $24.38 up, 6.5% move for Celestica. And then TerraVest Industries, also a gainer today. It's up 2.8%. That's a $4.10 move per share. Let's go to Bloomberg's equities reporter Stephanie Hughes now for more details on the movers. Stephanie, let's start with BCE stock. Moved down today. The telecom reported earnings. What happened?
Yeah, that's right. So it's kind of a mixed earnings bag. So BCE shares fell by 5% at their lowest point, which was the biggest intraday drop since October. And that's even despite the fact that its results of about 69 cents in adjusted earnings per share came ahead of what analysts were expecting, and their 2026 guidance was pretty much in line with the three-year plan that they laid out in their investor day late last year. And so there's a few things that traders could potentially be reacting to. One of them, maybe the more obvious one, is the operating revenue miss that they reported on the top line in their before the market opened today. So they could be reacting to that, but I also had a chance to get in touch with Desjardins Securities analyst Jerome Dubray, who said that it might be also the market reacting to a lack of improvement in organic EBITDA in 2026 coming off of 2025. He also pointed out that the recent outperformance in the stock might be leading to a bit of profit taking, and how BCE is joining other telecom firms in deeply discounting their wireless services, which especially during the Black Friday holiday season that we just saw pass. So while it might be good for attracting subscribers, maybe not so good for the revenues.
Okay.
So this also could be just an underwhelming response from shareholders who are expecting to see something new, Mirella.
Okay, let's get to Canada Goose because it's also a dismal day for them. They reported earnings. What did the Parka maker have to say?
Yeah, that's right. Canada Goose really losing its wings here. That stock fell by over 24% at its lowest point, which marked its second biggest intraday drop of just on record since it began trading. And it also dragged the stock price to its lowest level since May. So the company earned $1.43 per share. That came below the street's estimates of about $1.62 per share. The adjusted earnings before interest and taxes were the margin therein, at least, also fell short of what the street was hoping to see, which was actually kind of surprising because the fiscal third quarter is usually a seasonally strong quarter if you think about it. So it's the 3 months leading into the end of December. That's when people are getting ready for winter, getting some parkas, or it's the holiday season, they're getting something for their loved ones. But apparently that wasn't the case. Just think about the weather that we had in Toronto over the last few weeks. Apparently that wasn't the case this time around. So today's drop was beat by only one other single day rout, and that was back in May 2019. So what happened there was that Canada Goose lost over a quarter of its market value after its fourth quarter results had a revenue miss for the first time ever. And that was raising some concerns about whether its soaring growth prospects were actually sustainable. So some of those concerns about its growth ahead in the year are coming back. There's some skepticism there. And that's why you're seeing this harsh double-digit sell-off in Canada Goose today, Mirella.
Okay, we will leave it there. Thanks for the update, Stephanie Hughes from Bloomberg. Coming up next, Amazon set to release fourth quarter earnings. Everyone's looking forward to that. We'll get into the numbers when we come back. Results from Amazon just coming into the newsroom. AMZN on the NASDAQ. Fourth quarter results as follows. Net sales coming in at $213.39 billion. The estimate was $211.49, a Bloomberg estimate, so a beat there. Online store net sales, just shy of $83 billion. The estimate had been $82.3. Physical stores net sales, $5.86 billion. The estimate had been $5.88, so a little bit of a miss there. Subscription services net sales, $13.12 billion. The estimate had been $12.74, so a beat. Here's a key one. AWS net sales, $35.58 billion. The estimate had been $34.88 billion, so a beat for Amazon there. Earnings per share coming in at $1.95. Estimate was $1.96, so a bit of a miss there. Here are some key metrics. First quarter outlook, so the forecast. Amazon sees first quarter net sales coming in at $173.5 billion to $178.5. The estimate in the middle at $175.54. And then the key CapEx number that investors have been concerned about. CapEx for 2026 spending coming in at about $200 billion. and the estimate was 146.1. So a major disconnect in CapEx spending from what was expected. Let's go to Alonzo Munoz on this, Chief Investment Officer at Hamilton Capital Partners. He joins us now to digest some of this. Thanks for joining us today. Let's start with CapEx. Do you see that amount of CapEx spending as warranted by this company?
Morella, good afternoon. Good to be here. Well, clearly in the price action after market, investors are not liking this. We'll see if maybe we get a little bit of recovery as we all get on the earnings call here at 5 o'clock. But this is what we've been seeing as a trend in the market. These hyperscalers, these large tech companies, and Amazon here at their earnings reporting tremendous CapEx. I mean, absolutely staggering. And we expected it a little bit. I mean, it really is a race to build out the AI infrastructure and to be a leader. We think that ultimately this is a good thing. This is what these companies have to do. And Amazon specifically, that we see not only as a tech company, but it's really in that consumer discretionary. It serves consumers all over the world. And we saw some strong numbers from AWS. So we think that the CapEx is strong. The market's obviously going to have a reaction to it. And we're going to be watching that earnings call very closely.
As you know, Alonzo, the investors want to see return on investment. And I'm looking first at AWS net sales, which did beat. But do you think they beat enough? It was $35.58 billion, estimate at 34.88.
Well, Morella, that's exactly the point. I mean, we're really scrutinizing AWS and their cloud because it makes up such a big portion of their operating income, and they're becoming ever more reliant on growth in cloud to drive that future prospect, specifically as we potentially go into a slower economy, the consumer pulls back. But the numbers were okay. I know we've only had a couple of minutes to start to look through the numbers and really dig into the details, but margins were okay. That their online sales were okay. AWS a little bit higher than expected. It's going to be a little bit bumpy here for Amazon, but ultimately this is an opportunity for investors that like the company, that see the vision to start to average into this company. It's down on the year. It's underperforming its sector, and we think it has some upside.
Okay, so let's pull up the after hours and take a look again at how investors are reacting to this. Because as you mentioned, when we first had it up, they weren't too happy, especially and likely because of the CapEx spending being so far from the estimate at $200 billion for 2026. And it is still trending down. So now down 8.3%. That's an $18.43 drop. $204.26 is where Amazon stands in the after hours right now. And just a reminder for viewers that the numbers have come in and they beat on a couple of things, but they weren't major beats. Earnings per share coming in a bit of not a beat there, a miss there, 195. The estimate was 196. And then the first quarter outlook has net sales coming in for the first quarter, 173.5 billion to 178.5 billion. And that's inclusive in the sense that the estimate was 175.5, so that landed in the middle. AWS, which we were just discussing, coming in at 35.58 billion. That's a key one for this company. The estimate had been 34.88 billion. And then a number of other metrics to give you here. Physical store net sales coming in at 5.86 billion. A bit of a miss because the estimate was 5.88. Let's go back to Alonzo and take a look at some of the breakdown numbers. Outside of AWS, online store sales, is that sort of the next most important metric you're looking at, or would it be subscription services at this point?
At this point, it really would be subscription services. We know that Amazon is rolling out Alexa Plus, and that hopefully is going to be a driver of revenue here in 2026 and beyond. We've seen some partnerships as well with OpenAI, and so we're really trying to think outside the box for Amazon and how they deliver to shareholders on some of these promises that they're making and differentiating themselves in a space that has become rather fickle. I mean, if you think about what we've seen in the last couple of weeks is big market reactions to high CapEx or underperformance relative to other AI companies that are either developing faster or bringing products and services to market. Amazon's going to have a tough time, but I think on a positive note, we've seen Andy really position this company as the next world's largest startup, if you will. We saw some job cuts, at least in the last couple of weeks. We saw job cuts last October. But I think ultimately we're really going to rely on this earnings call to see what they have in stock for this year and how they're going to develop and how they're going to turn this $200 billion in CapEx into meaningful returns for shareholders and now for the company itself.
All right, Alonzo, we'll leave it there. Thanks for joining us. Alonzo Munoz, Chief Investment Officer, Hamilton Capital Partners. Coming up next, we'll take another look at Amazon's results with their next guest and then the broader tech meltdown that's been going on. Back in a moment. It is hard on a day like today to believe that the AI bull market is alive and well, but our next guest does believe that. Let's go to Doug Clinton, founder and CEO of Intelligent Alpha. Thanks for joining us today.
Thanks, Marilla.
Let's start with Amazon, which is in after hours dropping. They have a huge CapEx spend, $200 billion for 2026. The estimate had been far less than that. What is your take on the amount of money they're putting into this and whether they will see a proper return out of it?
Well, unfortunately, the AI trade, I do think it's still alive. It doesn't feel very well right now, but I actually think that this CapEx number from Amazon is a sign, and Google too, a sign that this hyperscale build out is going to continue. And so there's kind of this funny thing, I think, going on in the market where it feels like all of AI is selling off, despite us hearing from two of the biggest players in the game, Google and Amazon, in consecutive days, that they're raising CapEx by more than 30% this year to continue to build out and meet demand for AI. And so right now, I just feel like we're in kind of a general risk-off environment. I don't think it's really a commentary that this trade is dead. I think it's just investors don't really know what to think. They see this big CapEx number, they sell it. They're selling the infrastructure players too because other people are. I think we'll eventually weather this and get back to a trade working, but it might take another week or two to get there.
Okay. Do you see a divide right now in how investors are treating hyperscalers? Meaning, are they treating some a little bit better than others, or are they just sort of pulling the carpet out from all?
It feels like after today and seeing what's happening with Amazon, they're sort of pulling the carpet out from all. I sort of understood the Microsoft case last week when we saw the Azure numbers. They were, a touch disappointing. Then we saw Google post yesterday an incredible GCP number, mid 40% growth. The street was looking for mid 30%. The Amazon number today, 2% above the street, I think was a strong number. And so I think at this point, investors don't really care almost to some degree what the actual fundamentals are saying about the business. They're saying, hey, these are big CapEx numbers. We're not sure what to think now. And they're just selling on that reaction.
Okay. On the software side, does the sell-off make sense? Anthropic dropped another new financial AI tool today. We know about the legal contract one earlier in the week. Does the wide sell-off in software in that space make sense to you?
It unfortunately does, and I say unfortunately because our AI, we use software at Intelligent Alpha to do a lot of our stock analysis, to do our portfolio management. Our AI has liked some of these software stocks, and what our AI has tried to do is pick some of the names that we feel are a little bit more insulated from this, broader trend toward vibe coding using Claude or Codex to build applications that might compete here. Some of the ones our AI has liked, companies like a ServiceNow, for example, I think those companies are still relatively insulated from being disrupted by, somebody just on the weekend, right, using Claude Code and creating a competitive system. But things like Adobe, which we also own, I think that one, it does worry me a little bit more, because I think now people can go and they can ask some of these LLMs very specific things they want to do with photos, for example, and they might be able to totally circumvent even using a tool like Photoshop. And so I think you really have to kind of pick and choose in this software space the right names to get it right. Okay,
so do you think then, given what you have just mentioned, where yes, some of them will their businesses may not survive what's going on, do you believe the sell-off is going to continue?
I think at some point you have to get a breather, just simply from a market mechanics standpoint. Nothing ever goes down forever. Even when you think about historical analogs, bubbles popping, in many cases you would have rallies in bubble popping scenarios where the market might roar back 50%, even if it was in a downtrend. And so I think the thing you have to think about with these software names is if you're trying to short them, I think you have to be careful in terms of people rushing back into the names when it feels like sentiment has just totally washed out. It feels like we have to be close to that point, Morella, but I kind of thought that 2 weeks ago, and here we are. And so I think that just speaks to the difficulty in timing the market.
Okay, so we talked about software, we talked about wider tech, meaning hyperscalers. What are you doing with your AI plays to move them forward? Are you still looking at energy for data center build out? Are you looking at companies that you think are going to get some benefit from employing AI in their businesses?
We're looking at two spaces. One is in that energy segment that you mentioned. I think the fundamental fact is we just saw these two hyperscalers, Amazon, Google, raise their CapEx by a huge number. They're going to have to power the data centers that they're going to be building with this incremental CapEx. And so I think that's good for companies like GE Vernova, where they build turbines to power the data centers, potentially companies like Vistra, again, independent energy suppliers like them. And so we own those two stocks. I think they can continue to work as demand for power stays high. The other place that we've gone is what I would kind of call the AI safety trade. And as we've talked about, there's so much uncertainty in this market. Things are changing so fast. I think two names that feel like they have really strong moats right now are Google and Apple. And if you think about what will the big theme be in AI this year, I think it's probably personal intelligence, and AI that sort of knows you, can act as your personal assistant. Those two companies feel like they have the best rights to figure that market out. And I think that could be $1 trillion market opportunity. And so those two companies, even though Google got beat up a little bit yesterday and today, I think they're a pretty safe place to hide out if you're not sure what to do right now.
Okay, hiding out sometimes works. Doug Clinton, got to leave it there, sir. Thank you for joining us.
Thank you.
All right, let's get to some earnings results coming in from Canadian software company OpenText. Second quarter results, adjusted earnings per share coming in at $1.13. First of the $1.11, so year over year. The estimate had been $1.03, the Bloomberg consensus, so beat for them on earnings per share. A revenue coming in at $1.33 billion. That's a decline, under 1% decline. The estimate had been $1.29 billion, so we'll be there. And then cloud revenue, $478 million. That's a 3.5% increase year over year. The estimate had been $474.8 million, so a beat for them in that category as well. Licensing revenue coming in at $184.2 million. That's down 2.5% year over year, but above the estimate, a lot above the estimate of $162.3 million. Again, it came in at $184.2. Okay, let's tell you about adjusted gross margin, 77.6% versus 77.2% year over year. The estimate had been under 77 at 76.6%. Up next, shares of BCE closed down today. The telecom giant missed revenue expectations in the latest quarter. Our conversation with the CEO in just a moment. Ottawa is dramatically changing its policy for the auto industry, and they're looking to change the tariff system to create a stronger incentive for automakers to invest in Canada. So there will be consultations on a new import credit scheme that'll help automakers lower their tariff bill. Counter tariffs on U.S.-made cars and trucks are going to stay in place as well. The federal government is also going to drop that 2035 EV mandate and bring back the consumer incentive. Shares of Canada Goose plunging after the luxury parka maker posted profit in its latest quarter that missed estimates, as well as margins that came in below expectations. The disappointing results are due to heavier marketing spending and one-time charges. On the upside, direct-to-consumer revenue rose 14%, led by strong performance in North America and in Asia. Shares of Barrick Mining sliding today. The miner posted profit and revenue in its latest quarter that topped estimates, but investors are pointing to the company's weak outlook for 2026 production, as well as free cash flow that came in below expectations. Barrick announced it's going to spin off its North American gold assets in an IPO. That'll include interest in Nevada and the Dominican Republic. Shares of Rio Tinto are down after the company said it's walking away from talks to acquire Glencore. Rio says it ultimately could not reach an agreement that would deliver value to shareholders. Glencore had rejected Rio's takeover bid, saying the terms significantly undervalue the company and fail to reflect the value of its copper unit. Shares of BCE closed lower today after the company missed revenue expectations. Joining us to break it down, the fourth quarter results, the performance of its new U.S. acquisition of Ziply Fiber, and how AI is shaping the business, was Curtis Millen, CFO of BCE and Bell Canada.
Service revenue, it's important to point out, service revenue actually grew. Product revenue, which was a decision we made strategically, product revenue is down as volumes in market were a little bit down. So wireless prices were a little bit down in industry, so fewer contracted sales, but basically decision-making on our part, strong growth, but more bring your own device and fewer contracted sales, so it leads to product revenue weakness. But ultimately, service revenue strength. Even more importantly, if you look at 2025, free cash flow growth of 10%, free cash flow growth post lease repayments, 17.5% free cash growth year over year. And importantly, we're driving that free cash flow strength while we continue to invest in our business. So $3.7 billion of CapEx in full year. We continue to invest for the future, so we feel pretty strong about our ability to generate free cash flow going forward.
And we are, of course, going to get to some of the investments that Bell is making. But just first of all, just going back to the earnings report, like you posted better than expected profit this quarter. So tell us what's behind that side of it. Is that because of the investments you've made?
It's investments we've made, but I'd say it's also just investments we've made in our customers and our products. So we tend to think about, the first of our four strategic pillars is in kind of put the customer first. So, the focus on improving customer experience is really showing results, not only in our gross adds in terms of sales and market, but there's been a churn improvement 3 quarters in a row at this point. So, we still have the ability to go out and create new customers, new sales, but we're holding on to our customers more and more as we improve customer experience and reduce churn. So ultimately that leads to better financial results, but it all starts with better customer experience and lowering churn.
Is that why you're holding on to your customers, better customer experience, or is it more of a lack of competition?
No, I mean, look, this is a competitive industry. As we've all seen, pricing in the market is a competitive venture. So the offer and value that we're providing to customers continues to go up. And our focus on leveraging technology to provide service when and how customers want it, access to self-serve, better digital capabilities, and frankly, just delivering a better service and better experience day over day, week over week, month over month is driving improved churn performance.
Okay, so let's talk about some of the investments that Bell has been making. I know AI is a real big focus for BCE moving forward. It already has been. There are some data centers that Bell AI Fabric Network has invested in and is planning to help build out. Tell me more about those data centers. Where are they exactly, and where are we in the process?
Yeah, thanks for the question. I do think it's an interesting moment in time. I mean, AI is here. It will help reshape our economy. And if we can help be part of that kind of Canadian sovereign backbone, then I think it's good news for our shareholders, but good for the Canadian economy writ large. Ultimately, yes, given where we sit, given our telecom and ability to build out fiber, data centers, as well as we wrap Ateco and Bell Cyber capabilities around it, I think we're in a pretty good position to actually help accelerate AI adoption in Canada and play an infrastructure role and, as I said, kind of backbone of AI and data center role there. So good for the economy, good for our enterprise customers, and good for us financially.
What about the acquisition of Ziply Fiber? I know that was completed just kind of midway through last year. Is that part of Bell's kind of plan to integrate more into the U.S.?
Yeah, it's a fair question. I think the main story is fiber, right? Fiber is just a superior product to cable. I mean, it's superior in Canada. We see that with share of net adds. Our fiber loads are very strong where we have fiber. And it's a similar experience in other jurisdictions and including in the US. And it so happens that in Canada, we've built out far more fiber than they have on a relative basis in the US. So there's there's much less penetration of fiber. So we saw an opportunity to actually extend our capabilities, and it's a very strong management team in the US. So our combined capabilities are going to allow us to drive fiber growth in the US and bring fiber to communities in the US that frankly only have copper or cable. So we are first fiber in the market, which is why we're able to drive such growth and frankly meet customer demand.
What's the timeline for that, do you think?
I think it's ongoing. So we closed, as you said, 5 months left in 2025, and the ramp up there is just continuous at this point. We have plans to reach 3 million homes by the end of 2028. We're about halfway there, with plans to get to 2028 over a longer term horizon. But the opportunity is pretty significant. I mean, fiber ultimately just wins in the marketplace.
Got it. I remember your investment day back in October. You announced, or BCE announced, it was going to save $1.5 billion in costs by 2028 through, quote, company-wide transformation and continued focus on operational efficiencies. Where specifically, where will these cost-saving measures come from in the company?
Yeah, thanks, Lindsay. And look, we're halfway there, and it's 100 different files and it's 100 different data points. But if I had to explain it under a broad theme, one is, as I talked about, our customer experience and customer efficiency is just getting better and better. So that means fewer calls to the call center. Folks are moving online. Customers are more comfortable in a digital world. So a lot more self-install, self-serve, digital capabilities. And as we improve our customer experience and customer service, again, frankly, folks don't have to call us or interact with us as much because they don't have problems that need to be solved. So the continuation of digital transformation across our entire kind of internal workflows, as well as all of our interactions with customers, ultimately lead to more efficient customer experience, happier customers, customer transactions, and more efficiencies for us on the cost saving side.
So the cost saving comes from customer satisfaction?
Yeah, ultimately, I mean, it's one of those rare cases where providing better customer service actually leads to more cost-efficient service as well.
Okay, just lastly, we were talking about competition a little bit earlier, a different kind of competition. This deal between Netflix and Warner Brothers Discovery, if that goes through, obviously that's still pending. There's a bit of back and forth there. How much do you anticipate that might hurt Crave's distribution deal with HBO?
Yeah, it's a fair question, Lindsay. Ultimately, at this point, I would point to a couple of facts. One is, we have a lot of content on Crave. Kind of around the world, folks have recognized some shows that we have produced ourselves in Canada, Canadian content, so Empathie in French language at the start of the year, and more recently, Heated Rivalry. So we do have a lot of different content, not just from Warner Brothers or HBO on Crave. And I'd say it's a great service. I mean, we uploaded another 10,000 hours of content, and we loaded an incremental 1 million subscribers through 2025. So 1 million new subscribers to our content streaming platform. So we're incredibly proud of the content that we produce and the streaming service that we offer to our customers.
So the potential deal between Netflix and Warner Brothers is not really a concern for BCE?
I think we're just going to continue doing what we're doing, and that's providing the right service with great content on air.
All right, let's get to fourth quarter results from Strategy, a Bitcoin treasury, the world's largest publicly listed Bitcoin treasury. Fourth quarter results, revenue coming in at $123 million. That's about 2%, 1.9% increase year over year. The estimate had been just a little above that, $123.2 million from Bloomberg. A loss per share, $42.93 versus a loss per share of $3.03 year over year. Digital assets coming in at $58.85 billion. The estimate had been much higher at $70.28 billion. A number of Bitcoins held end of quarter at 713,502. Product licenses and subscription revenue coming in at $59.6 million. That is a 26% year over year increase and above the estimate, which had been $54 million. The stock, as you can see, is going down in after hour trading, losing about 2%, just over that at this time. We'll dig further into crypto when we come back. Stay tuned. The start of the year has been a rough one for cryptocurrency investors, with key coins like Bitcoin dropping almost 30% last month. The slide being felt across the entire sector as uncertainty around their ability to store value continues. Let's go to Ryan Rasmussen. He's head of research at Bitwise, and he joins us to talk some more about this. Thanks for your time.
Happy to be here.
What do you see as driving what is now an extended downturn?
I think that right now what we're seeing is momentum taking over the crypto market. We've seen sell-off across majority of crypto assets, not just Bitcoin, but Ethereum, Solana, as well as crypto equities. So right now we are in a bear market. We think we've been in a bear market now for a number of months, and sentiment is very negative and momentum's taken over, and we're continuing to slide lower.
Okay, why do you think the sentiment has gone this way? I mean, we're seeing tech sell off. We understand sort of what investors' concerns are with tech. It's a lot of cap spend. What do you think it is for crypto?
I think crypto is being hit by a few idiosyncratic risks that are being now priced in. Quantum computing risk is certainly something that a lot of folks are talking about across the crypto industry. And I think that's now being priced in a way it wasn't 6 months or prior to that. But I also think that liquidity is just low across the ecosystem. Investors are trying to figure out, is gold going to continue its run? Isn't there an AI bubble? How does crypto fit into this picture? And so sentiment from retail investors is certainly down. Now, I will say the institutional investors that we speak to at Bitwise every single day, including investors I've spoken with today in this week, believe this is an incredible buying opportunity and think that they're going to get great entries here.
Okay. Bitcoin, as you know, recently fell below 65,000 US. Some analysts looked at 70,000 and said it was a line in the sand. Do you see it as that one?
There's a few different technical levels that we're looking at right now. Most of those sit between 55 and 70K. So we've certainly broken lower than 70 and lower than 65. Our view is that it's difficult to catch a falling knife here, and that most investors are typically better off dollar cost averaging into these lows. What we've seen historically is that when Bitcoin has these major sell-offs, it creates wonderful buying opportunities, but timing that exact moment can be difficult.
Okay. Why do you think, or do you think investors are turning towards gold or other precious metals at this point instead of crypto?
Look, I think investors are really concerned with the outlook for fiat currencies. They see fiat debasement happening around the globe. It's happening here in the US. It's happening in other economies as well. They see the amount of debt that governments continue to go into, and they continue to not address those issues. And so they're looking for ways to hedge against debasement. And that's continuing to be a trend that we're hearing when we speak to investors. And what started as a central bank driven trade in gold has now moved entirely into a momentum-based trade that's driving gold and other precious metals higher. And I think that's reflective of investors realizing there is a need to hedge against fiat debasement and spiraling debt and spiraling inflation and irresponsible money management. And Bitcoin is one of those levers that can, and we believe will be pulled in the future to help hedge against that. That's exactly the market that it aims to serve. Right now, it's trying to find its footing as a newer asset. But we believe as this theme continues to grow, the need for a hedge against debasement, that Bitcoin is going to find a place in most investors' portfolios over the next decade. And that's why we believe that the long-term outlook for Bitcoin has actually never been brighter. The market it serves is growing at a very rapid pace.
Okay, so what do you think would need to turn this around? What in 2026 do you think could come to bring back momentum to the upside?
It's a really good question. There's a lot of catalysts that we see as long-term drivers of Bitcoin's growth. It's hard to pinpoint a specific catalyst in 2026 that could turn the market around. I will say that if Clarity Act, which is broad market crypto market legislature and regulations, gets passed this year, then I think that will be a positive catalyst. But long-term, the catalysts that we're looking at are institutional adoption, wealth managers and other financial advisors and money managers allocating to Bitcoin. We're also seeing growth of things like stablecoins and tokenization, which are really incredible use cases for crypto that we believe are going to revolutionize the way that assets move across the world and across markets. And then if we do see central banks starting to buy Bitcoin, I think that'll be a near-term catalyst that helps reverse course. But over the long term, institutional buying, regulatory tailwinds, growth in the store value market, and the need for a hedge against debasement, tokenization, stablecoins, these are all things that are long-term catalysts for Bitcoin. And the investors we're speaking to believe that those will be long-term catalysts to drive Bitcoin and the crypto market higher over the long term.
Ryan, can I get your take on the Canadian government's introduction of the Stablecoin Act and some of the requirements there, like asset reserves and redemption policy? What do you think of it?
Look, I think it's really important that governments around the world are starting to put regulatory framework in place for things like stablecoins. We were never going to see the massive growth in this technology and adoption of this technology until we had clear rules and regulation in place. So I think it's a huge step forward that governments are starting to do this. There's, of course, nuances that need to be worked out, but we believe that over the long term, stablecoins and crypto will be on the right side of digital and the right side of these trends, and that regulators will find a way to embrace this technology, as will corporations, as will companies that serve consumers and other businesses and financial markets globally.
Ryan, I got to leave it there. Thank you for your time. Ryan is head of research at Bitwise. Coming up, Lightspeed raising its guidance for 2026. We got more from the CEO. That's coming up in just a moment. Lightspeed posted its third quarter earnings today. The point of sale company raised guidance for 2026, but adjusted profit was lower than analysts had expected. We were joined today by Dax Da Silva, CEO and founder of Lightspeed Commerce.
We build the whole system for running those businesses. So complex retail and hospitality businesses. The retail businesses are primarily in North America, and the hospitality businesses were the #1 system in Europe. So we do the end-to-end operations as well as the payment processing.
Right. Do you provide value-added services to companies? I mean, do you provide loans or lines of credit and stuff?
So as an extension of our payments platform, our financial services platform offers merchant cash advances. So yes, we have a capital business that's vibrant and growing as well.
So tell us what your stock is down in the past year. Just remind us why that is.
So we're doing a very disciplined transformation, which is prioritizing our two growth engines. That's 2/3 of our business, our North American retail business and our European hospitality business. And we showed, fantastic results, for Q3, but for those growth engines in particular, really top tier 21% growth in those growth engines and 2,600 net new locations. So adding a lot of locations on those growth engines, and in addition, 13% software growth. So the strategy is really paying off. We set a 3-year CAGR for getting to 10 to 15% location growth, and we're at 9% right now. So we're very much on track. And we're also on track for our 3-year EBITDA target and our gross profit target. So, it's a quarter by quarter story of execution, but very, very pleased with how we're delivering.
So you raised your revenue guidance for fiscal 2026. I mean, you're a huge company to north of $1.2 billion. And it's up slightly, but it looks as though your EBITDA, interesting, below the street, $72 million approximately, and the street was closer to $73 million. So really not a huge difference, I know. But why is that profit forecast slightly lower than the street, do you think?
Right. So, we've accelerated on our locations from 5% in Q1 to 7% to 9%. And that's really because we've been investing in outbound salespeople in North America retail and European hospitality. In European hospitality, it's more field reps going restaurant to restaurant in major European centers. And in North America retail, it's outbound remote reps calling into key verticals like apparel and footwear and sport and outdoor businesses, leading with our wholesale platform that's called New Order. So Those reps are a big investment. We've hired all 150 reps, and we're ramping them to full productivity. But we've had so much success that we're bringing forward some of that hiring into Q4 so that we can start fiscal 27, with fully ramped reps, tackling, in particular in this case, tackling that retail business, which has got a massive TAM.
So my rule for, I'm not a big foodie, but my rule for eating in Europe is if the menu's in English, don't go there. So say if I'm at some place in the back streets of Siena and I'm running a small restaurant, why would I go with your payment system? I'm sure my local bank could offer me something equivalent.
Yeah. So when you go to Michelin star restaurants or you go to resorts, and actually, if you go into almost any cafe or restaurant in Europe that's got table service or a bit more complexity, you'll see Lightspeed. And I think all the businesses recommend Lightspeed to one another. It's a little bit of a support network within their own within their neighborhood. It is the system, especially when you're doing multi-course meals. Of course, Michelin star restaurants, but then even casual dining, anywhere that there's table service, or you have a multi-location chain, or you have a restaurant as a part of a hotel or a resort. We are an excellent fit.
But you haven't got the same traction in restaurants in North America?
Yeah, I think what we did when we unveiled our strategy at Capital Markets Day last March, we looked at where our two products, our key flagship products, which are the retail product and the hospitality product. The hospitality product has DNA that comes from European acquisitions. So it's really, tailored and fiscalized for all of those different countries. There are particular workflows and different partners in the ecosystem in Europe. And so, previous to the new strategy, we were trying to sell that software all over the world, and there was low ROI in other areas outside of where that software actually comes from, which is Europe. And in North America, and so we've been building out that software for about 10 years. And on the retail side, we've been building out that software in North America in key verticals for 20 years, starting with the very first software that I built back in 2005. And they don't let me program anymore, but but we've built out, a really incredible and deep retail expertise in high complexity, inventory centric retail verticals in North America. And so that's where we have the best close rates, the highest rate to win, the biggest competitive moat and differentiation now with our wholesale platform built right into the retail POS. And then, of course, in Europe, we are the number one, full service restaurant system in Europe. So, and that's how our numbers have just really benefited quarter after quarter since we began the transformation of focusing on where we have a right to win and where we have virality and fantastic close rates.
One story that caught our eye this week, a BBC story, we hope to get to it later, is that when people order on these screens that you'll see at fast food restaurants or in IKEA at the food their restaurants, people tend to order more. Now, I don't know if those screens or automated food ordering things are a big part of your business, but have you heard, does that tend to boost revenue for the restaurant?
Yes, we do partner with companies that add kiosk capability to our platform. We do see that. Whenever you're not in front of someone and you're ordering, your food, and you've got a little bit of privacy, you're ordering more delivery, you're ordering more at a kiosk. But for the most part, we're serving those restaurants where people are going out as entertainment to dine and also on the retail side to shop, right? So there is a brick and mortar, a physical, social entertainment element to it. But yes, we also serve those scenarios where people are sneakily increasing their order because nobody's watching.
Sometimes nobody watching is good. Dax Da Silva, CEO, founder of Lightspeed Commerce. Here's how we ended the day on Bay Street and Wall Street. It was an ugly one. The TSX Composite down 1.8%, 576 points down on the day. The S&P 500 an 84-point drop, 1.2%, and the NASDAQ 1.6% down. Thanks for joining us on The Close. We'll see you tomorrow.